Navigating the economic tide. The impact of economic cycles on different asset classes. Introduction. In the intricate dance of global markets, economic cycles emerge as the choreographer, orchestrating the rise and fall of prosperity. The undulating nature of economic cycles, characterized by phases of expansion, contraction, and recovery, exerts a profound influence on various asset classes. Investors, seeking to navigate the complex terrain of financial markets, must grasp the nuanced ways in which economic cycles shape the performance of different assets. Expansion phase. During the expansion phase of an economic cycle, characterized by robust growth, rising employment, and buoyant consumer confidence, certain asset classes bask in the glow of prosperity. Equities, or stocks, often take center stage as corporate profits surge, driving stock prices higher. Investors flock to the stock market, anticipating strong returns fueled by economic vitality. High-yield bonds, benefiting from a favorable business environment, also tend to perform well during this phase as companies exhibit strong creditworthiness. Real estate, particularly in sectors tied to economic growth such as commercial and industrial properties, experiences heightened demand and appreciation. Commodities, driven by increased industrial activity and consumption, may witness price appreciation, with energy and industrial metals often leading the way. As the economic tide lifts these asset classes, investors strategically position themselves to ride the wave of expansion. Contraction phase. Conversely, the contraction phase, marked by economic slowdown, rising unemployment, and diminished consumer spending, introduces a different set of dynamics to the asset landscape. During these periods, fixed-income assets such as government bonds become attractive havens for investors seeking safety. The prices of high-quality bonds tend to rise as interest rates decline, providing a counterbalance to the volatility in equities. Defensive sectors, including utilities and consumer staples, often prove resilient during economic contractions. These sectors offer products and services that remain in demand even when disposable incomes shrink, providing a buffer against economic headwinds. Investors may also turn to precious metals like gold, historically viewed as a store of value during times of uncertainty, as a hedge against economic turbulence. Recovery phase. As the economic pendulum swings towards recovery, asset classes undergo a metamorphosis, adjusting to the changing landscape. Equities, having weathered the storm of contraction, regain momentum as businesses adapt and resume growth. Cyclical stocks, tied closely to economic trends, often outperform during the recovery phase as consumer confidence rebounds and industries begin to flourish. Real estate, which may have struggled during the contraction phase, sees a resurgence as demand for properties increases and lending conditions improve. As interest rates remain relatively low early in the recovery, housing markets often experience a boost, creating opportunities for investors in both residential and commercial real estate. Additionally, high-yield bonds and certain commodities, sensitive to the revival of economic activity, may present attractive investment prospects. Inflationary pressures. Economic cycles are also intertwined with inflationary pressures, influencing the performance of various asset classes. In periods of inflation, commodities, especially those with intrinsic value like precious metals and agricultural products, often serve as inflation hedges. Real assets, such as real estate and infrastructure investments, may also provide protection against the eroding effects of inflation, as their values tend to appreciate alongside rising prices. Equities, particularly companies with strong pricing power, can navigate inflationary environments successfully. These companies possess the ability to pass on increased costs to consumers, maintaining profitability. In contrast, fixed-income assets face challenges during inflationary periods, as the real, inflation-adjusted returns on bonds may diminish, impacting their attractiveness to investors. Interest rate dynamics. The ebb and flow of interest rates, closely linked to economic cycles, play a pivotal role in shaping the performance of asset classes. In periods of economic expansion, central banks may raise interest rates to cool off an overheating economy, impacting both fixed income and equity markets. Rising interest rates can lead to bond price declines, making existing bonds less attractive compared to new issuances with higher yields. Conversely, during economic contractions, central banks may lower interest rates to stimulate borrowing and spending. Lower interest rates generally benefit bond prices, as yields on existing bonds become more attractive in comparison to the lower rates available in the market. Equities may also benefit from lower interest rates, as the cost of capital decreases, potentially boosting corporate profits and stock prices. Global economic cycles and diversification. Investors operating in a globalized market must recognize that economic cycles can vary across regions. Diversification. The practice of spreading investments across different asset classes and geographic regions becomes a crucial strategy for mitigating risks associated with economic cycles. A well-diversified portfolio can help buffer against localized economic downturns and capitalize on opportunities in regions experiencing growth. For example, an investor holding a globally diversified portfolio may navigate a situation where one region is in an economic downturn, while another is in a recovery or expansion phase. By strategically allocating assets across different regions and sectors, investors can enhance the resilience of their portfolios in the face of unpredictable economic cycles. Conclusion. In the ever-evolving landscape of financial markets, economic cycles stand as both architects and disruptors, molding the destiny of different asset classes. Investors who grasp the significance of these cycles and adapt their strategies accordingly can harness the power of diversification, selecting assets that align with the prevailing economic winds. As economic tides ebb and flow, astute investors navigate the complexities of the market, crafting portfolios that stand resilient in the face of uncertainty and poised for growth when economic conditions are favorable.